You know, every single company out there, from the tiniest startup to a global giant, faces the exact same puzzle. How do you grow like crazy without blowing up your finances? It is a constant, tricky balancing act. Today, we're going to open up the toolkit and look at the two key metrics that help solve this puzzle: the weighted average cost of capital, or WACC, and the sustainable growth rate, SGR. So it all boils down to this one big question, right? This is what keeps managers up at night and what investors are constantly trying to figure out. How do you hit the gas on growth, but also make sure the company's foundation is rock solid? If you nail this, you create incredible value. But if you get it wrong, well, you can drive a great company right off a cliff. Okay, here's how we're going to break this down. First, we'll get into WACC, which is basically your project's hurdle. Then we'll talk about SGR, which you can think of as your company's growth speed limit. After that, and this is the fun part, we're going to mash them together into a super useful decision-making matrix and look at the 4 different scenarios it creates. First up, WACC. Now, the absolute best way to think about WACC is as a hurdle, like in track and field. For any new project or investment to even be considered worthwhile, the return it promises has to be high enough to clear this hurdle. If it can, it's not creating value, it's actually destroying it. So what is it officially? Well, WACC is the blended, or weighted, average cost a company pays for all its financing. That's the money it borrows, which is debt, and the money it gets from shareholders, which is equity. Honestly, just think of it as the price tag on the fuel that makes the whole business run. So if you're a manager, this is one of your go-to tools for sure. You're looking at a new factory, right? The first question is the return we expect to get higher than our WAC? It's a simple yes or no. It also helps them figure out the best way to pay for things. Should we take out a loan or sell more stock? The goal is always to tweak that mix to keep the WAC as low as humanly possible. Now, let's flip the coin and look at it from an investor's perspective. For them, WACC is absolutely crucial. It's the number they use to figure out what a company is actually worth. A lower WACC suggests lower risk, which makes all the company's future profits more valuable today. A high WACC, on the other hand, that screams risk and can be a huge red flag. All right, let's switch gears to our second tool, SGR. Look, if WACC is the hurdle you gotta jump over, then SGR is your speed limit. It tells you how fast you can grow using only the money the business itself is generating. It's a pure measure of your internal organic horsepower. In textbook terms, the sustainable growth rate is the top speed a company can hit without needing to ask for outside money. No new loans, no selling more shares. But what does that really mean? It means this is the growth you can afford all by yourself. For managers, SGR is a total reality check. Let's say the big strategic plan calls for growing 15% next year, but then they calculate the SGR and it's only 8%. Uh-oh, that's a funding gap. Now they have a choice. Either make the business more profitable, pay out less in dividends, or go out and find more money. And for investors, it's the same thing, a reality check. When a CEO gets on a call and promises the moon with these huge growth numbers, a savvy investor immediately compares that to the SGR. If a company is growing way, way faster than its SGR year after year, it might mean they're piling on a ton of debt or watering down shareholder value to do it. Okay, so we've got our hurdle rate, WACC, and our speed limit, SGR. They're powerful on their own for sure, but what happens when we put them together? Well, that's when the real magic happens. That's when we get a crystal clear strategic map. And that brings us to the main event, the WACC SGR matrix. This is just a brilliant framework. It shows you the 4 and only 4 strategic positions a company can be in just by plotting its cost of money against its ability to grow on its own. And here it is. It's actually pretty simple. On one axis, you've got WACC, is it low or high? On the other, you've got SGR, again, low or high. And boom, you get 4 quadrants: the sweet spot, the growth trap, the efficiency play, and the red flag zone. And trust me, each one calls for a totally different game plan. All right, let's really dig into what each of these quadrants means. Because figuring out where a company is on this map, that's everything. It tells you exactly what to do, whether you're sitting in the CEO's chair or deciding if you want to buy the stock. First up, the place everyone wants to be, the sweet spot. This is the dream scenario. Your financing is cheap, that's a low WACC, and your business is a cash machine that can easily fund its own growth. That's a high SGR. And what's so cool here is that everyone's on the same page. The manager's job is clear: step on the gas, reinvest every dollar you can to scale up.
And from an investor's point of view, this is a flashing green light. It signals a healthy, value-creating machine. Okay, next up is a really tricky one, the growth trap. This one looks good on the surface. The company has a high SGR, so it can grow fast. The problem, its WACC is also high, which means that growth is super expensive to fund. This is a very dangerous place to be.
And this is exactly where things get so risky. Managers feel this pressure to grow, grow, grow. But because their cost of capital is so high, every new project is barely profitable, or worse, it actually loses money. Investors see this and get nervous, worrying that all this growth is just destroying value.
All right, scenario 3 is what we call the efficiency play. You can think of this as the classic, mature, stable company. Capital is cheap because they're seen as safe and predictable, but their SGR is low simply because their market is all grown up. There's just not much room left to expand.
So the game plan totally shifts here. For managers, it's not about chasing growth anymore. It's about squeezing more profit out of what they already have. For investors, especially those looking for steady income, these are the companies you look to for reliable dividends. And finally, we land in the most dangerous spot on the map, the red flag zone. This is just a brutal combination. Your financing is expensive and your business isn't generating enough cash to grow on its own. You're stuck. The key word here is urgency. There is zero time to mess around. Management has to make big, painful changes, restructure, slash costs, maybe even pivot the whole company. For investors, this is a clear stay away sign, unless you have a really, really good reason to believe a major turnaround is about to happen. So we can boil this whole thing down to a really simple 4-step process. 1, figure out your hurdle rate, your WACC. 2, assess your internal growth engine, your SGR. 3, find out where you are on the matrix. And 4, armed with that knowledge, make the right strategic call.
In the end, this framework isn't just some academic exercise. It's a real-world map for making smarter financial decisions. It forces you to balance that exciting ambition for growth with the cold, hard discipline of creating actual value. So I'll leave you with this question. Now that you have the tools, which zone is the company you're looking at in?